Stocks break down from an inside wick and from a triangle formation. The market breadth, however, is oversold. Will we finally get a rally soon? Interest rates hit multi-year highs and Treasury bonds are in danger of further declines. All this and more in today's edition of MasterChartsTrading.com. Market recap for, you can see, Saturday, September 23rd, 2023. It's late and I am recording this, so please support this channel by hitting the like button, subscribing to this channel, and of course sharing this video with others. Note that today's video, this week's video, will not cover gold and dollar and Bitcoin. It will be covered in members only video. If you're not yet a subscriber, consider signing up by going to MasterChartsTrading.com. Additionally, as always, I'm going to be using my MasterChartsTrading.com price action indicators, for which you can sign up on my site. All right, it's late. Let's get to it. S&P 500. Let's look first at the weekly chart. So, as I said, S&P 500, this is the actual index, broke down from a triangle formation and from an inside wick. Last week I mentioned that, notice this candle right here, this is the week of Monday, September 11th. Okay, I'm going to zoom in a little bit more. So notice what happened last week is the close last week was below the close from the week from September 5th. And I said that this is not a good sign for two reasons. One is that this is the first time since August 14th, week of August 14th, that we closed below previous week's close. Okay, number two, we broke down from an inside wick. So an inside wick where I'm hovering this week was September 5th, was entirely within the range of Monday, August 28th week. So you can see that it's called an inside wick. So the range is entirely within previous candlestick. So this previous weeks marked the beginning of this breakdown. This week, obviously, we had a big decline. Large red candlestick is quite bearish, quite bad. So not only this week we broke down decisively from the previous inside week. I had a comment, at least one, that said that one way of looking at inside wick is where is the breakdown? Where do we consider a breakout? Out, up, or break down from this inside wick? And one way of looking at it is that we need to close below the low, or at least make a new low below, previous week's low, or close at least, or an open. The actual body of the candle. Well, whatever way we look at it, definitely we broke down. Additionally, you can kind of see this triangle formation. I just kind of drew it in. I don't normally look at triangle formations or formations in general because you can misread them quite often. You can kind of imagine what things look like, and then maybe it's a triangle, maybe it's not a triangle. But this one kind of jumps out at you, and every time there is an inside week or an inside day, you can think of it as a triangle formation because it's basically narrowing of a trading range. And this week we broke down decisively from this triangle formation. So what's happening right now? We are retesting the lows. In fact, we actually are below already lows from August 2014. Week of August 14th, 2023, this week. We can kind of go back to daily charts now. So notice that on Friday today, or yesterday, 22nd of September, we closed below this low from August the 18th. Additionally, we closed below this low from 26th of June. So, you know, not a very good sign. I mean, maybe this is a head and shoulders. I'm going to draw it in. That's another reason why I don't, you know, just normally look at any kind of patterns. Maybe this is head and shoulders. If this is head and shoulders, then we broke down below it. What do you guys think? Is this head and shoulders? Do we care about those patterns? I sometimes care, but normally I just look at my lines. So on this chart we can see this lines, this green, blue, red and yellow lines. And for now, there is no ifs or buts about it. We're still in a bullish uptrend. So whichever way you look at it, we can say that if we look at total return, S&P 500 ETF SPY, then the bull market began right there on February 2nd, where I'm hovering, when we closed above the blue line. If we're looking at index itself without the dividends, then the new uptrend or new bull market began on April 13th, 2023. And for now, this is intact. The way I look at things is that once we close above the blue line, we need to make a significant push lower towards the yellow line to make it to begin a new bear market, a new downtrend. And from today's levels, we're like 15% away. So really quite a bit of work the bears need to do before we say, okay, you know what, this little bull market that barely got started is now over. We're not there. Clearly, the evidence is still in favor of bulls. Additionally, I will show you that we are already somewhat oversold on multiple measures. So number one measure, we're looking at my lines. We are already below the green line, so we're already somewhat oversold. When or if we get to the blue line, and now it's becoming more and more likely that indeed we will retest the blue line, which is currently around 3% away, we will become pretty significantly oversold. Okay. Now, what I want to point out here is I want to show you my projection of my lines into the future. So I'm gonna turn them on for a little while. I'm gonna just show it to you what we're looking at right now. So notice that the indicator lines are kind of curving upwards. Okay. So what does that mean? That means that the bear market, where is it currently at? You know, pretty far away, at like 15% away. The bear market in early November, where I'm hovering, will become much more achievable for bears. So if nothing happens, we just trade sideways, like we're just gonna trade sideways, then by the time November rolls around, bear market will be only 10% away. Okay, because the way you can see the indicators are curving up and they're narrowing, they're coming closer together. So this is telling me that now the likelihood of a trend change is becoming more likely, and it will become easier for price to continue lower towards bearish levels. Once again, this hasn't happened, and we need to actually see the evidence of that happening. So for now, once again, I'm treating this whole thing as an oversold condition, oversold within a bigger uptrend. Okay, so this is just looking at my lines, looking at price levels, looking at price action. Now let's look at what's called market breadth. So you can read about this various indicators if you go to StockCharts.com, click on Chart School, and you can actually type in and read about it. So for example, this is what's called a bullish percent index. I already showed it last few weeks, I think. It's an indication of how many stocks within the S&P 500 are on a buy signal according to this particular way of charting things. So bullish percent index is used, bullish percent index. It's called, the charting method is called point and figure, and you can see it's radically different than normal charting. You can read about it, but a bullish percent index shows how many stocks within the S&P 500 are on a buy signal according to this method. See, you can see point and figure buy signal. Okay. So the bull market, according to my system, began around February of 2023. This down below here is S&P 500. Up here is the actual bullish percent index, and it goes from 0 to 100, because you can have either 100% of stocks within the S&P 500 on a buy signal, or you can get as low as 0. Now, it's quite unlikely that this happens, and even during the like 2007, 2009 bear markets, not 100% of stocks went to sell signal. Like a few stocks remain. So it's very unlikely that all of the stocks will be either on a buy signal or on a sell signal. So it's a oscillator. It oscillates around 50%. Sometimes it gets high, sometimes it gets low. So during the bull market uptrend, we need to look for oversold conditions to find a good entry points. Vice versa, when we have a bear market, as we had up to February of 2023, we need to look for overbought conditions. So looking at this chart, for example, back in June of 2022, we had an overbought condition with a 63% of stocks within S&P 500 being on a buy signal. That's too much for a bear market. Lo and behold, we got a new low afterwards, and again we had another rally higher. So again, we had quite a bit of stocks on a buy signal, as high as 80%. Okay, and then again, eventually it rolled over. We had a new low. Okay, something happened. Eventually, we got to beginning of the year 2023. This year, we switched back into the bull market. How do I know? Once again, I already showed this to you using my lines. You can see that we began our uptrend in February of this year. So in February of this year, we started uptrending for S&P 500. So what at that point we started looking for oversold conditions. And what's oversold in a bull market? The way I look at it, at least 50% of stocks need to be on a buy signal, and if they're less than 50%, they're at least somewhat oversold. Can they be deeply oversold? Absolutely. In fact, we got a deeply oversold level in March, right there. So the lowest came around March 15th. There's the March 15th low, okay, and then we had a huge rally, really just a tremendous one. Okay, so oversold condition definitely works in favor when we're looking for a good buying opportunity. But even somewhat oversold condition within around 40%, 40, even 49%, it's still pretty good, and the rally continued. You see here back in May, June. So right this instant, what we're looking at is a reading of, number one, below 50%, so already somewhat oversold, and current level is 43%. Okay, we're approaching this red line, and this red line is at 38%. I put it as a Fibonacci retracement. Not really anything particularly important about that number, but I figured it's kind of interesting. So we are super close to a relatively deeply oversold level based on this market breadth indicator. Will we immediately get a rally if we get to 38%? No, not necessarily. We can drop further. Okay, So what I'm just trying to tell you is that the deeper we get, the more likely we will get a rally. And we're getting there. We're getting pretty close. Another market breadth indicator that I look at is put-call ratio. Again, I showed this in the past. This is kind of like think opposite. So when there are too many puts, people think that the stock market will collapse. Puts are bought with an intention of market going down. Okay, so it's a bearish bet. Put is a bearish bet. So when we have way too many puts, usually the opposite happens. So the more puts, the more likely you will expect a rally. Okay, vice versa, if you have way too many calls, like we had in July-August time period, we can actually look at July-August. There is the July-August. Yeah, we really went pretty high, and we had a huge rally that started back in here in like March. Nice big rally. Okay, so at that point we had so many calls that everybody thought that, okay, we're not gonna stop, we're just gonna go to the moon, straight to the moon. Okay, and the opposite happens. When we have so many calls, we see a correction. Okay, we're getting this correction. However, right now, once again, we have quite a bit of puts. We have significant number of puts. We just haven't, we're trading pretty high up as far as puts are concerned. So that means that we're having more puts. We're expecting a rally. Okay, will this rally happen immediately? Not necessarily, because maybe we'll get something of a double dip kind of thing. So we got a small rally, like in August into September. There it is, August into September. It was pretty small. And now again we have quite a bit of puts. Notice that we're above this red upper line here. And yeah, this is again, expect rally. Okay, when we have so many puts, that means that everybody or many people think that that's it. Okay, we are going to have I don't know, the end of the world. Okay, so will the end of the world happen? Maybe, but maybe it will not. I mean, the end of the world happens once, and then that's it basically, right? So I want to bet on a continuation of world continuing, right? I don't want to be betting on the end of the world. If there is the end of the world, then that's it. There's not much you can do really. So at this point of the game, I think we have again too many puts. I think I'm expecting at least a bounce and possibly a rally. And again, ideally, we should pull back towards the blue line, bottom there, and then just go towards 52-week highs. Will it happen? Yeah, there's a good possibility of that. The only question is how deep of this correction are we going to continue having. So according to at least two measures so far that I just described, bullish percent index is relatively oversold, approaching pretty strongly oversold levels. Put call ratio, definitely more puts than needed. We're expecting a rally. Finally, I wanted to show you one more measure of market breadth, and that is percent of stocks above 200-day moving average within S&P 500. So how many stocks within S&P 500 are above the 200-day moving average? What's the 200-day moving average? So here's one. I put it in. This 200-day moving average for S&P 500 is at 422 right now. We can look at Apple, for example. Here is Apple it is currently above 200-day moving average, so it will be counted as +1. Okay, so S&P 500, within S&P 500, how many stocks are above the 200-day moving average? Currently, 43% of stocks are above the 200-day moving average. The way I look at it again is that I think 50% is relatively oversold already. Okay, if we get to below like 40%, that is deeply oversold for a bull market, for an uptrend. For a downtrend, you can see it got down to like 12. Okay, and we were looking for opposite. So for example, if we were using this indicator to trade bear market rally, so a clear example of bear market rally was the one that started in June of 2022 and continued into August 2022. Notice the reading for this indicator, the percentage of stocks above the 200-day moving average, went above 50%, and then that was a good place to start, to sell short. Okay. So during the bull market, the opposite. I think 50% is already quite oversold, and we're at 43 right now. All right. So if we get to like 40, that's where the previous rally unfolded. We got down to 39 in March of this year, and in March of this year, so we can look at what happened in March of this year. There's the March of this year. Yeah, oversold levels, huge rally afterwards. Okay. So again, all of these three indicators, the bullish percent index, the put call ratio, and percent of stocks above 200-day moving average, are indicating that we are approaching the bottom, at least an intermediate one. I don't know if this will be the bottom, but it's definitely becoming oversold. So we are looking we're looking for a bottom, basically, for S&P 500. Where it's gonna unfold, we're super close. So the 200-day moving average is an indicator many people use. So 200-day moving average for S&P 500 is currently at 42.60. My blue line is at 41.88. So we're very close to where many people will consider stepping in and buying already. Okay, moving on to Treasury bonds. Here's TLT, 20 plus year Treasury bond fund. It's doing horribly. This is a daily chart. Notice we're so close to the previous lows that were set in October of 2022. Notice also here that this is called adjusted. Where I'm hovering, it says ADJ, so it's blue. It means it was clicked. If I unclick it, notice that we're already below previous lows. Okay, so if we adjust for dividends, meaning we add the dividends into this total return, we're not yet below October 2022 lows. Okay, but we're super close, and if we break below that level, I think it's not a good sign at all. So I'm going to show it to you on the weekly chart first. So weekly chart of TLT. Okay, there it is. So this is a very bad looking pattern. This is a bearish pattern. If we break below the previous lows, there is a good chance that the depth of this pattern will be duplicated on the downside. So that means that we could see a significant move lower for Treasury bonds. This is TLT, another 18% down after this breakdown. Looking at TYX, or Treasury bond yield. Remember, the Treasury bond funds prices and Treasury bond yield moves in opposite directions. So this is a yield on a 30-year Treasury bond, and is currently at 4.5, and it is above the previous highs, and this is a multi-year highs. In fact, it is like a decade, not multi-decade, but we haven't seen this type of yield since 2011. So let me see, that's the 13 years. Okay, so that's a 13-year high. Okay, it's pretty significant and does not look good. Again, if this is what's happening, and we're not going to just all of a sudden turn around and at least not, you know, stop going up, then I think it's quite possible we will get a duplication of this depth of this pattern. So this is the pattern I'm referring to. I'm gonna draw it in briefly. Let me see, where is the I can't find it for some reason. So this is the pattern. Okay, this like cup-like pattern. Okay, so right now we're breaking above the high. We actually have closed above the high. So not a good sign. I think now we can say that bonds may not have bottomed, and maybe we'll see another leg down for bonds, for Treasury bonds. So the depth of this pattern is about 30%. Another, 1.03%. So another 1.03% will put the 30-year yield at around 5.6. We can look at TNX, which is a 10-year yield. 10-year yield would look like that. So another, it's currently at 4.4, so another percentage point or so. We're looking at about 5.5 or so for a 10-year yield. So mortgages very likely are going to continue higher. And again, with bonds, looks like there is quite a good chance that this is not the bottom for bonds, and maybe we'll continue lower. So this is what we're looking at right now. Will this affect stocks? Make a comment. What do you guys think? And head over to MasterChartsTrading.com. Sign up for trading indicators. So these are the lines on this chart. They're available for TradingView.com, this interface, TradingView.com. TradingView.com is a free interface. All you gotta do is sign up on my site, and then I'll open the door for you on TradingView.com. I also have a newsletter that I send out daily. So for example, this week we will cover all of these various stocks, and I send out alerts about them throughout the week. And of course, the best deal is to get both trading indicators and newsletters at $59.95 per month is a good deal. I also have now yearly pricing. I just don't have it added here. So if you're interested in yearly pricing, send me a message. Contact me right here, and I will send you an invoice link so you can get signed up for a yearly pricing. I will eventually integrate it. I just haven't gotten to it. You can see it's Saturday night, and I'm recording this video. All right, again, please don't forget to hit the like button, subscribe to this channel, share this video, and again, thank you for watching, and have another great trading week. Bye.